Good morning, good afternoon, good evening to all of you wherever you are. My name is Roxanne Dogbegan, the President of the Institute of Directors, Ghana, and the Chair of the ACGN Chairs Forum. I wish to welcome you to this important session. The Vice Chair of ACGN, the Chairs Forum, our keynote speaker, Professor Mervyn, Mr. Patrick Kabuya, our second speaker, chairs of corporate governance institutions on the continent, distinguished ladies and gentlemen, I welcome you to the third edition of the ACGN IOD Chairs Knowledge Sharing Session. Our first two sessions discuss the state of corporate governance in Zambia and Kenya. Today, we're going to discuss one of the new paradigms in corporate governance, which is integrated thinking and reporting. The formation and creation of this forum was born out of the critical need to ensure that our African continent is able to leverage on the strengths of its experts in corporate governance to promote networking and knowledge sharing among key stakeholders to promote good corporate governance outcomes. The Chairs Forum concept was adopted on the 28th of August 2021, and on the same day, I was elected as the first chair of the forum, with Dr. Eric Juru, the President of Zimbabwe Institute of Directors, as the Vice Chair, and Madam Victoria Soluntogwe, the past President of Zambia, IOD, elected as the Organizing Secretary. Distinguished ladies and gentlemen, before I set the ball rolling, I wish to start my first public statement with a very important observation. A new wave of electing and appointing of professionals is blowing across our continent. I have observed that some of the recent political positions on our continent are being filled with professionals who are members of IOD, corporate governance institutions. This is very encouraging and a good pathway for accelerated development and reorientation towards good corporate governance on the continent. It is instructive to know that the newly elected President of the Republic of Zambia is a member of the Institute of Directors, Zambia. The current Acting Inspector General of Police in the Republic of Ghana, Dr. George Akufo-Dampare, is a fellow of the Institute of Directors, Ghana. The Governor of the Bank of Ghana and his two deputy governors who are leading major reforms at the banking and financial services sectors in Ghana are honorary fellows of the Institute of Directors, Ghana. The current board chair of the Ghana Revenue Authority, Dr. Tony Otinjesi, who was appointed less than 2 months ago, is also a fellow of the Institute of Directors, Ghana. Mr. Danny Luswili chairs the Zambia Telecommunications Company and also chairs the Copperbelt University, a public university. Mrs. Bridget Muyenga, Commissioner of Finance at the Zambia Revenue Authority, are all members of IOD. This is just to mention a few. Distinguished ladies and gentlemen, it is very refreshing to see the utilization of the expertise of our members in such key positions in our country. It might be necessary to create a database of all our members who are in such high positions in all other countries to track the performance for the world to see the difference made when the right professionals are in the helm of leadership as opposed to non-professionals in leadership positions. It's about time we promoted the leadership of strategic outlets on the continent for occupation by our well-qualified and result-oriented people as a key to turning our fortunes on the continent. In Ghana now, the Director General of State Interest and Governance Authority, SIGA, is advocating for the publication of CEO and board positions of state-owned enterprises to allow for the selection of the best talents for the job role. This is a positive development, which if managed well should lead to good governance outcomes. This may be worth emulating in other countries on the continent. Distinguished ladies and gentlemen, it appears to me that we have every resource on the African continent, but let us ask ourselves why we are not developing in a manner that is comparable to developed countries. Is it a lack of ideas? Or is a lack of willingness to develop? Most of the time, we blame it on the lack of resources. It is my humble opinion that we have every resource on this continent. Therefore, Our attitude and lack of sustained willpower to follow and teach sound ethical principles, perhaps, is the problem. We need an ethical, effective, result-oriented leadership to be able to transform the attitude of our people on the continent. What we observe is that majority of our people do not abide by the principles of good ethics, integrity, taking responsibility, respecting laws and regulations, being productive and being on time. We need the right people at the right places with little interference from political leadership. There is the need for us as professionals to lend our support to political leadership in a very strategic manner. We need to get more involved in the governance of our public organizations and countries. Our current political leaders must be ready to embrace our services as professionals into the leadership space for effective utilization of our skills and talent. The former World Bank President James Wolfenson once said, corporate governance will become as equally important as political governance. And to quote Professor Mervyn, he says good corporate governance is about ethical and effective leadership, good performance, effective controls, and legitimacy. On behalf of the chairs of corporate governance institutions on the continent, I wish to encourage all political leadership in all African countries to ensure the utilization of services of Institute of Directors in the various countries on the continent. Where those institutions are not strong, it should be the responsibility of the political leadership of those countries to support the local institutions to grow. It is said that charity begins at home. Distinguished ladies and gentlemen, our discussion today is going to focus on integrated thinking and reporting as a new paradigm in corporate governance. It is important for me to mention that 2 years ago, we invited Professor Mervyn to Ghana, and he tasked the Institute of Directors to establish and promote integrated thinking and reporting culture in Ghana. I'm very happy to report to Prof and the world that today we have a legally registered association promoting integrated thinking and reporting in Ghana. At this stage, may I crave the indulgence of the first chair of Ghana Association of Integrated Thinking and Reporting, Mrs. Elsie Awazi, the second Deputy Governor of the Bank of Ghana, to introduce our keynote speaker to us. I wish us all a successful interaction. Thank you.
Thank you very much, Mr. President. And a very good afternoon, good morning, good evening to you, wherever you may be. It is my singular honor to be able to introduce a most distinguished gentleman who we'll all have the pleasure of listening to in a few moments. Our keynote speaker for this event needs very little introduction for those of us who've been in the corporate governance space for a while. But it is only fitting that he is given his due. And so I'm going to attempt to provide a summary of his credentials. Professor Mervyn is the senior counsel and former justice of the Supreme Court of South Africa. He is professor extraordinaire at the University of South Africa on corporate citizenship, and he's an honorary professor at the Universities of Pretoria and Cape Town, as well as a professor at the Wits Business School of the University of Witwatersrand and a visiting professor at Rhodes University. He is the patron of the Good Governance Academy, which is currently housed in the Wits Business School, and which holds colloquia on critical governance issues and distributes a memorandum to over 2 million members of local and international institutions. Professor King is recognized globally as the foremost authority on corporate governance. He believes that good corporate governance is about good leadership, sustainability, and corporate citizenship, and that organizations need to change the tone at the top, the tune in the middle, and the beat of the feet of those at the bottom. He is chair emeritus of the King's Committee on Corporate Governance in South Africa, which produced the well-acclaimed King 1, 2, 3, and 4 reports. and he chairs the Good Law Foundation. He is Chair Emeritus of the Value Reporting Foundation, Chair Emeritus of the International Integrated Reporting Council in London, I beg your pardon. He is Chair of the African Integrated Reporting Council and Chair of the Integrated Reporting Committee of South Africa. He is also Chair of the Global Reporting Initiative in Amsterdam and a member of the Private Sector Advisory Group to the World Bank on Corporate Governance. Professor King chaired the United Nations Committee on Eminent Persons on Corporate and Oversight, on Corporate Governance and Oversight, and was president of the Advertising Standards Authority for 15 years, and a member of the ICC Court of Arbitration in Paris for 7 years. He has been a chair, director, and chief executive of several companies listed on the London, Luxembourg, and Johannesburg stock exchanges. He has consulted, advised, and spoken on legal, business, advertising, sustainability, and corporate governance issues in over 60 countries all around the world, and received many awards from international bodies around the world, including the World Federation of Stock Exchanges and the International Federation of Accountants. Professor King holds an honorary Doctor of Laws degree from the Universities of Witwatersrand in South Africa and the University of Leeds in the UK. He holds an honorary doctorate from Deakin University, Melbourne, Australia, and an honorary doctorate in commerce from the Stellenbosch University in South Africa. He has received lifetime awards for achievement in several countries from several professional bodies as well. He's a fellow of the Royal Society of Arts and Commerce, honorary fellow of the Institute of Chartered Accountants of England and Wales, and of the Institute of Internal Auditors of the UK, and on and on and on. Professor King was the South African representative at the International Commercial ICC International Court of Arbitration in Paris for 9 years, and still acts as an arbitrator and mediator in commercial disputes internationally. He is the author of several books on corporate governance, sustainability, and reporting, the latest being one called The Healthy Company. Ladies and gentlemen, I could go on and on and on talking about the great achievements of this distinguished gentleman, but I do hope that you have a little bit of a glimpse of what he brings to us this afternoon. Professor King, your audience, thank you very much.
Thank you very much for that erudite introduction. I think everybody out there knows more about me than I know about all of you out there. But thank you for that introduction. It sets the scene for what I'm going to talk about today, and that is the change in thinking of the people at the top of limited liability companies. It's the directors, the board, as individuals and as a collective mind. So I need to start at the beginning, and I need to take you back to the middle of the 19th century, when there was a huge debate that happened in the United Kingdom and in the United States of America. And that was that wealthy families were not prepared to provide risk capital to organizations when they failed from a business point of view. Those wealthy families were still liable to the creditors and the employees of the company. So they started balking against giving risk capital to these organizations. But of course, the government of the day in the United Kingdom and the state of Massachusetts in the US wanted this continuation of the capital flows to organization to start businesses, to create more jobs, exactly what governments of today are trying to do. And there was thinking that, why don't we, the representative of the people, create an artificial person which may be incapacitated, but we will appoint leaders to lead this entity. It was opposed by especially theologians at the time who said, who are we as mankind, in those days it was mankind and not humankind, to create a person? Only Almighty God can create a person. Notwithstanding this vociferous opposition, the government of the day in the United Kingdom, being the representative of the people, passed an act of parliament creating the limited liability company. What was the limitation? It was that the providers of capital, known as shareholders, because they got a share certificate which said they own, let's say there were 100 shares issued, so they got one share certificate, that this reflected their participation on 1/100th of the business of the company, its revenue, and eventually its bottom line before tax. And so the architecture was created, the governance architecture of this limited liability company. So the limitation was that once on an initial public offering, subscription of shares, subscriber would, say, pay £100 for the one share, and each 100 shareholders would pay £100. Then the company would have that as working capital. And but that was an end to the shareholders' responsibility and liability. The concomitant to that, on the other side of that, was if the business of the company failed, the first people to be recognized and to be paid would be the creditors according to preference, secured, and then ordinary creditors, concurrent creditors, and then at the end of that queue would be the shareholder. In other words, if there was residual value of the satisfaction of creditors, that value would go to the shareholder. But during the lifetime of that company, the shareholder would have no duty or responsibility to the company. And there was no principle set out as to how those who were leading the company had to steer it, because the word direct comes from the Latin word to steer. And so they were called directors, but they were appointed according to the governance architecture by these shareholders. And other stakeholders, particularly employees, saw them as the owners of the company. And this was a myth, of course, because the shareholder couldn't, in those days there was a cash register, couldn't put his or her hand into the cash register and remove money from it. It would be a theft. The only way that the shareholder could get money out of the company was if the board of directors declared a dividend, and if there was sufficient liquidity in the company could pay that dividend. So we move into the 20th century, and by this time, the guardianship of incapacitated individuals, human beings, was well developed. That the guardian had to act with good faith, care, skill, and diligence in looking after this incapacitated, let's say, a 5-year-old child, and handle that child's affairs and plan for that child long term, because the physician said, well, physically this child is perfect, live well into his 90s. So they had to plan accordingly. This became eventually the duties of directors: good faith, care, skill, and diligence. So they owed their duties to the company. And if you owe your duty to someone, you must be accountable to that person. So directors are accountable to the company, and through the company to all its stakeholders. During the 20th century, however, because of some Supreme Court decisions in the UK, the US, and other jurisdictions, and Professor Friedman's thesis of the 70s, the focus was on increasing the wealth of shareholders. And it was believed that in reporting how you account should be focused on the shareholder. So the primacy of the shareholder was the governance which dictated how directors behaved right to the end of the 20th century, turning into the 21st century. But through the third industrial revolution, the computer age of the 70s and 80s, research was expedited, and by the end of the 20th century, we, thought leaders there and directors of companies, were shown empirically that the limited liability company was the biggest user of natural assets on planet Earth, and we're using natural assets faster than nature was regenerating them. There was clear evidence of environmental degradation. And in 1983, this was realized. And the United Nations appointed a commission to investigate this and asked the question, can there be infinite growth because populations were increasing in a finite world? Well, certainly the modus operandi of focusing on increasing the wealth of shareholders and the criteria for success being increased profit, increased dividend, increased share price was not working. That was being subsidized by society and the environment because we could actually see the degradation of the environment. And we could see from a health and safety point of view that in some cases child labor was being used in order to reduce expenditure. So the Brundtland Commission came up with its report in 1987 and said, and I paraphrase, that there are three critical pillars to sustainable development, and that is the economy, society, and the environment. And these three things are integrated. So for the first time, we heard that word, integrated, integrating these issues. The United Nations were hit by a scandal, the oil from food scandal, and they appointed a body which they called eminent persons and asked me to chair that body to look at the governance and oversight of the various agencies inside the United Nations, where the question of the sustainability of planet Earth was discussed in great detail. And that's where I really became accustomed to looking at things through a triple context of the economy, society, and the environment, and a full realization that companies have never operated in an economic bubble. They've always operated in this triple context of the economy, society, and the environment. During the first decade of the 21st century, an analysis of companies listed on the great stock exchanges of the world, including stock exchange in Ghana, showed that, and I'll take an average figure, only about 20% of the market cap of companies, how the market capitalization was made up, was reflected as additives in a balance sheet according to financial reporting standards, be they IFRS, International Financial Reporting Standards, or FASB, Financial Accounting Standards Board of America. And this led to the establishment of the Global Reporting Initiative to look at sustainability issues. How can we conduct business through the medium of the limited liability company, but in a sustainable manner, in a resource-constrained world? That was the critical issue. And the Global Reporting Initiative was formed, of which I became the chair, to establish guidelines as to look at the impacts of the activities of a company and its product when it went out into society, and how it impacted on those three critical pillars for sustainable development. Those guidelines eventually became standards. And because it was making up 80% of the makeup of market cap of companies and stock exchanges around the world, people started saying this is more important than the financial statements according to financial reporting standards. And the consequence was that there was a myriad of standard setters and framework providers that developed in this sustainability space, which became known as the ESG space, environmental, social, and governance space. And because there were so many framework providers and standard setters, this caused clutter and confusion for preparers and for users. So by about 2008, the International Federation of Accountants called for a meeting at the United Nations. It was at the Geneva headquarters. And at that meeting, where there were other international institutions such as the World Bank, it was Chatham House rules. Nothing goes out of the room, but it's now a matter of public knowledge. IFAC said, we have to accept, we as those who were reporting financially and directors around the world, that the way we do annual reports, which consisted of the annual financial statements according to these financial reporting standards, we as directors were not discharging our duty of accountability. Because how do you account? You account through reporting. And we were only reporting on 20% of the makeup of the market cap of companies. And companies then started doing sustainability reports. So you had these two silos. And I argued that these two silos, in fact, are divorced from reality. Because in reality, these things are integrated 24/7. And so this led to the establishment of the International Integrated Reporting Council, which was launched at St. James's Palace in London through the good offices of His Royal Highness Prince Charles. And in that, we developed a framework after consulting with iconic companies around the world and over 60 well-known academics and practitioners around the world for 2 years. We eventually developed the IR framework, in which we said that we as directors have to stop thinking in these silos, human resource, financial department, etc., because these things are integrated, as the Brundtland Commission had said way back in 1987. These things are integrated on a daily basis. And we described 6 resources used by organizations: financial, human, manufactured, social, intellectual, and natural. Capitals, we call them, or resources, used by any organization in carrying on its purpose. And we said these things are integrated 24/7. And so we should think on an integrated basis. The functions of a company. In automotive terms, the oil that lets the engine run smoothly to produce the company's product. Internal audit, company secretarial functions, governance, risk, and compliance. This is the oil that makes the engine, how the company makes its product or renders its service, is made. And there are outputs, because as you're producing your product, you're also producing waste. And so a value creation model was developed, which replaced this model of making profit, provided you were doing it lawfully, even though it was subsidized by society and the environment, and was really not adding value to society. But as long as you met those criteria of increased profit, increased share price, increased dividends, you were said to be successful. Well, it was seen right through that in fact, the planet Earth was degrading, and that was not the modus operandi. And so we developed this value creation model of inputs to the activities inside a company, how it makes its product, to its outputs that goes out into society. It has an impact, not only economically and financially, but socially and environmentally, and it has outcomes. So from inputs to outcomes, and we had to think of all this. I call it a symphony of resources and relationships between the company and its stakeholders. And that was integrated thinking together with these functionaries, like internal audit, company secretarial function, etc. By the time we got to the second decade of the 21st century, there were events, the collapse of Lehman Brothers and the GFC, global financial crunch, which showed that these three critical pillars for sustainable development were also having an impact on the limited liability company, both in the developed world and the developing world. So, in summary, there was a realization that the activities and products of companies were impacting on these three critical pillars. But these three critical pillars were also impacting on the limited liability company, its financial condition, its balance sheet, its operating performance, its income statement, its cash flow, its risk profile, its cost of capital. And so the word enterprise was added before the words value creation, which you will find in the IR framework, of how you connect all these things, all these resources and relationships between the company and its stakeholders. And enterprise value creation started looking at the impacts of these pillars on companies. And the concept of double materiality was developed in the last couple of years. What does that mean? That means if you look at the corporate sustainability reporting directives of the EU, which have now been issued, they will mandate, and they're going to mandate, that companies in the EU, and there are 50,000 companies operating in the European Union, must look at the double materiality of sustainability issues. That is, how the company's activities and product impact on the world, and how the world impacts on the limited liability company, which is probably the most important citizen in the developed and developing worlds, because it is the medium through which capital is raised and also the chosen medium through which businesses are conducted today and jobs are created. And so the International Financial Reporting Standards issued a consultation paper last year during the pandemic and came to a conclusion that it must not only have this international monitoring board where IOSCO, the SEC, and various other international bodies sit as members, looking and developing financial reporting standards. They must also develop sustainability reporting standards, which can be international, because the end game was stated to be a global comprehensive corporate reporting system. Well, that's a statement easy to make, but very difficult to achieve, because the IFRS agreed that it should start issuing sustainability standards, and it has announced that it's going to create the International Sustainability Standards Board to sit alongside the International Accounting Standards Board. This Sustainability Standards Board will issue global baseline standards of sustainability reporting. And on a building blocks approach, you could look at any country. So I'll take a country, Belarus, which is in Eastern Europe, and it might have its own sustainability reporting standards. But the quality of those standards will be matched against these global baseline standards of the International Sustainability Standards Board under the auspices and the oversight of the International Value Reporting Standards Board, because it'll have oversight over the financial reporting standards and the sustainability standards. It is common cause amongst the task teams that are working on all this at present that there must be a connection between the financial and the so-called non-financial, the ESG factors. And the most informed body of persons to actually look at this is the board, because they get 4 to 6 times a year, they get reports on these critical issues, both financial and ESG issues. And the board should select that which is material defined as that having a significant impact financially and on environmental, social, and governance issues, and put it in this, I'm going to use the words now being used, this overarching framework over the IASB and the ISSB in clear, concise, and understandable language. So a user in Accra or Johannesburg or New York can understand it. Not every trustee of a pension fund, not every director of a company is educated in financial reporting, the corporate legal principles that some of us are blessed with, that we can understand these principles. And yet they are appointed as trustees of pension funds. They're appointed because of what's written in the last will and testament of somebody. And as you know, some shareholders appoint their best friend as the director of the company, but he or she is not necessarily skilled and hasn't got the expertise to make those business judgment calls in the long-term best interest of the health of the company. And so we need to make sure that our education is such that they are the young people coming out of business schools and universities today, and that's the reason I started the Good Governance Academy 2 years ago. And we now have 5 million followers, just by the way. To educate the educators, to make sure they're teaching this integrated thinking and to do an integrated report, a report which has an overarching framework over these 2 critical international bodies, which the ISSB will be announced in November of this year in Glasgow at the COP meeting. So you will see that corporate reporting is not what it used to be. And corporate reporting is the lifeblood of accountability. And we will see the eventual outcome and the standards of this global baseline reporting from November this year. At the same time, we have to govern our companies. We have to direct them. And corporate governance is about controlling and directing and making sure there are proper, adequate controls in place. And it had become a mindless checklist approach to governance. We have a nominations committee, we have an audit committee, we have a remunerations committee, tick the boxes. We're practicing good governance. Well, this became a mindless grudge compliance issue. And what we at the King Committee started asking was, corporate reporting has become outcomes-based, integrated reporting, inputs to outcomes. In 2015, the United Nations, to which every African country was a party, agreed to the Sustainable Development Goals, of which there are 17. The 17th is collaboration. The other 16 are all outcomes-based. Clean water, clean production, clean city. These are outcomes. The same as reporting became outcomes-based. So we asked the question, shouldn't governance be outcomes-based? And after talking to iconic companies and academics around the world, we concluded that governance should be mindful, not mindless, mindful and outcomes-based. In other words, when making a business judgment call, this collective mind of the board actually sees whether there is going to be an impact on the critical outcomes which external stakeholders particularly are seeing, and can rationally draw the conclusion this company is a responsible corporate citizen. Well, what are those outcomes? After much debate, we came to the conclusion there were 4 outcomes. Value creation in a sustainable manner in our resource-constrained world. Adequate and effective controls, in other words, the functionaries, were they operating adequately and efficiently. Trust and confidence in the company and the community in which it operates with legitimacy of operations. And then an ethical culture with effective leadership. Culture is really something internal. I like the American definition, how we do things around here when no one is watching us. The characteristics of a company is what external stakeholders see. And the characteristics are tied up in the business judgment calls you make and whether they meet these 4 critical outcomes of value creation in a sustainable manner, adequate and effective controls, trust and confidence in the company, and legitimacy of operation. Effective leadership means an acceptance by the directors that they're acting for an incapacitated person and that they are the heart, mind, soul, and conscience of the company. I have made speeches publicly, which was broadcast on the Australian Broadcasting Corporation, for example, that the company is innocent. By definition, it's an incapacitated person. So it can't mindfully do something wrong. When the company does something wrong, which has a huge adverse impact, let's say, on the environment, the wrath of society should not turn against the company. It should turn against the corporate leaders because they are the conscience of the company. And so integrated thinking and integrated reporting are absolutely critical factors. But a mindful, outcomes-based governance mindset of the board is critical as a paradigm for the future of corporate governance. And let me conclude by saying this. Our continent, the African continent, and my chief executive of the African Integrated Reporting Council, Patrick Kabuya, is going to speak as well. We recognize, and all of us should recognize, that we have a continent fully resourced, more than probably any other continent on planet Earth. And the one thing that we lack is good governance in governments and in companies. We have to start practicing quality governance. And of course, it requires a tone at the top to make sure the tune in the middle, the middle management, is operating properly, and that the beat of the feet at the bottom buy in to your business model. Because when you get that buy-in from everybody in these tiered relationships in companies to the business model and supported by the millennials and members of Generation Z, you can get ordinary people to achieve the most extraordinary things. And that's a personal experience. But if you don't get that buy-in to your business model, which incorporates SDGs pertinent to the business of the company, such as the saving of water, if you're the brewer of beer is your business, you can have PhDs from the top to the bottom, and you will not even achieve ordinary things. You can achieve extraordinary things when you get that buy-in and you get a feeling of pride in the company. So let me conclude by saying this, that governance and corporate governance and government governance is absolutely critical for the future of our continent. Thank you very much.
Thank you very, very much, Prof, for that brilliant presentation. Indeed, our African continent recognizes that we have a continent fully resourced, but one thing we lack is good governance. We need to practice good governance. There is the need for change at the top. This is the call. This is the direction we must go. And this is coming from our icon of corporate governance in Africa and on the globe. At this stage, we're going to go into the second presentation very quickly to discuss how we can promote these in our various countries, how we can form integrated thinking and reporting institutions and associations to promote these game-changing paradigm. On this note, I would want to humbly invite Madam Victoria Asolontogwe, the past president of Zambia Institute of Directors and a member of the Integrated Reporting Committee of Zambia, who is also our organizing secretary, to introduce the next speaker to us. So, Madam, you have the floor to introduce the next speaker. Thank you very much, Prof, for that presentation. Thank you.
Thank you.
Thank you very much, President Dogbega, for that introduction. And it is also my honor and rare privilege to be able to introduce Mr. Patrick Kabuya to the audience. Mr. Kabuya is a senior governance specialist at the World Bank Group. He works on governance issues ranging from public financial management, corporate governance, integrated thinking, sustainability reporting, integrated reporting, and strengthening the accountancy profession. He has an extensive wealth of skills, knowledge, and experience in these areas, and a global social capital network. He has served in diverse projects across the globe. Mr. Kabuya was instrumental in establishing and serves as the convener of the Africa Integrated Reporting Council, AIRC, that promotes and supports the implementation of integrated thinking, sustainability reporting, and integrated reporting in Africa. Mr. Kabuya is representing AIRC at the International Integrated Reporting Council. He is also the current co-chair of the World Bank Group of Integrated Reporting Community of Practice. He has served in several leadership positions over the years. He served in Ernst & Young office in Nairobi, Kenya, as well as the Johannesburg office, South Africa, and South Africa Institute of Chartered Accountants, SAICA, before his passion for development motivated him to join the World Bank Group in 2009. That is the profile of our next speaker, and I humbly request him to take the floor. Thank you very much.
Thank you, Madam Speaker, and jambo to all of you. In Kenya, we tell people jambo, so at least you know a language from our country, though I'm based in South Africa. And it's a privilege and an honor, Ms. President Roxon, for inviting me to this audience and to share some of our experiences on this important agenda. Prof Marvin, thanks once again for eloquent speech, as always, very informative. And I must say upfront, I'm honored that I've been serving with you in the Africa Integrated Reporting Council, in the international one, and most importantly on the Good Governance Academy. So for the 15 minutes being given, I think the whole aim, and I'm going to share some few slides with you just to present key messages that have been requested to share on how to establish committees that would be responsible for promoting this important agenda. And can I check whether you can see it? Oh, it's coming. Just a minute.
Yes, we can.
Cool. Yeah. So, how we can create this. So, listening to Professor Marvin King, there are many things he shared, but try to sum it up in two dimensions. One is that there is increasing shift on the corporate governance to become mindful and outcome-oriented. And he shared the 4 outcomes that are in the King 4 Code of Corporate Governance. And I guess as board members listening to me today, that shift is very important and can be achieved in many other shifts that are happening on that area on the corporate governance. He stated the need for you as the board members to increasingly incorporate the 3 elements of sustainable development within your business models or within your strategy and the operations there too. So the environment, the economy, and the society at large. He also articulated the need to shift from just focusing shareholders to stakeholders, very important change, and need to shift not only thinking from financial capital, which is an element that many boards always focus on, to all the other capitals, the 5 other capitals that you alluded to, which make up almost the other 80% of our organization. And that shift is critical and very important. But the second is then the shift on the reporting. That is no longer only on the financials, but we need to be preparing reports that include this element on the society and environment, sustainable reporting, and then integrate that information into a concise report with material information that would enable any stakeholder to understand how your organization, organizations at large, are creating value in the short term, long term, medium term, long term for the benefit of all the stakeholders. And that's key. So those are 2 critical dimensions. Unfortunately, we've not made a lot of move and changes within our region. What this means is we need to promote, we need to support, and we need to increasingly adopt this type of thinking and operations down the line. And as far as sustainability reporting, integrated reporting, we realized South Africa, while the other 55 countries in the region have made a lot of progress, but we still have a long way to go in the rest of the countries, even also in South Africa. So what did we decide to do to start promoting this area? In 2017, we created what's called the Africa Integrated Reporting Council, and that was mentioned briefly earlier on when I was being introduced. And what this council means is has 8 countries at the moment, and those countries were selected based on the stock exchange, the accountancy profession development, and represented by the CEO of the stock exchange and the CEO of the professional body. And its aim is to promote, support, and influence sustainability reporting, integrated thinking, and integrated reporting into the continent. So in 2017, we decided the Africa Integrated Reporting Council can't do all this in our countries. We made a decision as a council that all countries should think of a way of establishing their own committees, integrated thinking, integrated reporting committees, which would end up moving the reform, promoting the reform, supporting the reform in their respective countries. And what we did is prepared a guideline with principles of how a country that would like to establish such a committee would go about it. And I'm happy, I think Mr. Roxon, President Roxon, he announced there's one in Ghana. We've so far managed to establish the one you've mentioned in Ghana. There's one in Nigeria. Zimbabwe have also done establishing. Botswana has done the same. And there are 2 almost in the pipeline, one in Zambia and another one in Kenya, which may be launched in the course of this year. So what can we do to establish in the other countries? This guideline, all I want to share with you is 4 issues. One is the why, the who, the how, and what you can do to go about establishing this. So in terms of the why, so you're in a country, you may not have one. Yes, Ghana already have established such structure that would sustainably promote this, is to have 3 main objectives. Is to promote this reform. Not many people are aware of this evolution that's happening around us and the benefits that it brings. So such a structure would help to promote and create awareness to all the stakeholders in the country so they become aware about it. But secondly, is to support with the implementation. It's one thing to promote, the implementation is going to be critical. The guidelines, the capacity building in the country are going to be fundamental. And of importance also is to influence internally and externally as far as this reform is being concerned. And these 3 principles we believe are very important, and I hope that they form part and parcel of the association in Ghana and many others that are going to be established. And this should be well established and included in the constitution of the organization. So who should be part of this association or the committee? One thing we are emphasizing, it's not an accounting issue. Many people hear sustainability reporting and integrated reporting and immediately think, oops, this is accounting. No, it includes a lot of governance issues. It's also a governance agenda. And that's why we talked about bringing in the element of sustainability it's the SDGs in the process, integrating the functions. So it goes beyond accounting, and hence we're calling for multi-stakeholder membership in this association. And I've listed a few in this group. You can consider others in your country, but you need all of them to be included and to be invited to contribute in promoting, in supporting, and influencing the process in establishing the committee. Some lessons that we've learned so far are the following. One, it's important at the country level to have a champion, either as an institution or an individual who would say, this is my baby and I want to drive it to progression. And I humbly thank you, President Roxon. You've been learning, listening to Africa Integrated Reporting Council, and I know you've been a key driver in ensuring this happens. So for the rest of you listening to me in different countries, it'd be good to identify a champion who can drive this for its establishment in your country. It's also good to think of an influential chairperson, someone who can knock doors in your country, to a regulator, to a stock exchange, to the institute, so that they can listen and become part and parcel of the process. So your selection of who leads that association is also key and fundamental. And most importantly, bring everyone on board. I think we've faced some teething problems in one or two countries because some members felt they were left out. So let it be an open process and bring everyone on board so they feel they're participating and contributing to this important event. So the third then is, how do you establish it? So our guideline focuses on three forms of structures. And we learned this a lot from South Africa. So South Africa established their committee back in 2010, and they have gone through a number of phases, and we used that process to formulate these three structures. One is becoming a committee of an institution in a country. So the Institute of Director or the Stock Exchange or Accountancy Body says, we will establish the committee as part of our institution, bring everyone on board, provide secretarial services, and also resources. And this is the case in Zambia, Zimbabwe, at the moment. It's the case in Botswana at the moment. And in South Africa, that's how it started with SAICA buying the institutions. So you can consider the same. And then secondly, is registering it as an association, not for gain. And this is what you've done in Ghana. Even Nigeria have also gone the same route, where it's a registered organization, they are members, and they establish a governance structure to run that institution. And finally, is also as a legal body or company, limited company. I've not seen one so far, but the other two structures currently exist. Our guidance, start simple, maybe as a committee of an institution, and over a period of time, start building on it. And as you do that, it is important to have a constitution, and that constitution should include who are the members of it, should include the governance arrangements. How do you appoint the members of the governance? What is their term? How do you appoint the chairperson? What's the term? And importantly is how you fund your activities. It's very simplistic initially. They make it simple, don't make it complex. Ask the members to pay for their expenses initially. The sponsoring institution can cover the secretarial and have someone who is doing that role. And as you evolve, you can start charging levies and getting some portions and donations. And I insist on that. Start simple and use the resources you have as you build on this important agenda. And obviously the issue of the administration is key, and having someone who has the capacity, especially technical capacity on integrated thinking, sustainability reporting, and sustainability integrated reporting is key to guide your analysis and to guide the work of the committee. And then the final one is just on the what. What do you do? So we always tell the committees it's good to have a plan focusing on these three areas, and they can vary depending on your country. To focus on doing a kind of a needs assessment to establish what is needed to promote, to support, and influence these three streams of agendas, especially the one which is happening. And we've shared with you this a number of how you can do with the promotion. So especially the one on engaging with the stakeholders who don't understand, the regulators, so they may make this as a requirement is critical. South Africa has integrated reporting awards, which has helped promote the reform. In Kenya, they also have fire awards, and other countries also including similar awards. So that can help to promote and bring this on board, besides the conferences and the roundtables. And the roundtables can be in different forms. So have a session with the chairs of the listed companies, board of listed companies, chairs of the audit committees, board members, And I'm sure at the Institute of Directors or the institute represented here of directors, you can start including this. And then more capacity building. And I've shared with you a few examples of the capacity buildings that we need to hone in and incorporate within our own countries. And finally is on the influencing. So these standards are being developed outside. We talked about IFRS and the soon to be established the International Sustainability Standards Board. We as Africans need to focus and share our comments, not just to be takers, but also be influencers. So our research institutions should be doing research and send our comments. We should also aim to be represented in those international forums. I'm sure we are represented, but we can still do more. And of importance, like in South Africa, is how you include this agenda within the corporate governance framework. So here it's part of the King report, and thanks Professor Marvin King. And importantly is on our qualification programs. So the future, Professor Marvin King said, those who are in school, how do we empower them to learn more and to be part and parcel of us? So through your committee, work with tertiary institutions, work with business schools, professional accountancy bodies, the IODs to include these topics within their own program. Professor Marvin King did allude to the fact that SAICA, the Good Governance Academy, and the WITS Business School have a program called Chief Value Officer, and through that program, this topic is being empowered and people are being trained on how they can think in an integrated way, sustainability reporting, and down the line also on the reporting. So this is what I just wanted to share with you in terms of how to establish the who, why, who, how, and what, and happy to send a guide that can be distributed to all on this. It's an important topic for us to be able to achieve this mindful corporate governance. It's important for us to adopt this to change our reporting so we can be able to provide more information to our different stakeholders. And what that remains is it's on our hands. No one else is supposed to create these structures. And it's for the good of our continent so that we can benefit from our resources. And as Mandela says, what counts is what we're going to do on that. As you can see on my face, I challenge all of you. It's on our hands to create these structures so that we can promote this important agenda for the benefit of Africa. Once again, thank you, and happy to respond to any question.
Thank you very, very much, Patrick, for that good insights. And I'm excited about the summary you gave in your intro about Prof's submission. Well done, congratulations. Distinguished ladies and gentlemen, we'll expect your questions to come in. Whilst we look into the chat box, I note that it's been a very engaging session and the need for us to change our mindsets regarding the way we think, the way we create value, the way we report it is important in promoting the sustainability of our organizations. And therefore, we need a mindset change. We need a mindset change to be able to attract our stakeholders and remain in business sustainably. Businesses should be looking at the long term and not the short term. And therefore, we need to model the business concept to ensure that we are taking notes and taking account of the environment, society, and the economy in a manner that promotes the interest of stakeholders. Thank you very, very much. At this stage, I'd want to go into the question. The floor is open for questions. I see a question from Mr. ACGN Bone. He's asking, does integrated thinking and reporting require some training or certification? Is the sole responsibility of accountant? Is it the sole responsibility of accountant to prepare integrated reports? This is the question from Mr. ACGN from Ghana. So the floor is open. I don't know if Patrick takes this or Prof takes this.
Well, I'll start and then Patrick can add to it or subtract. The answer is no, you don't have to be an accountant. Accountants are trained in public interest issues. So I wrote the book in 2016, Chief Value Officer, and the subtitle was Accountants Can Save the Planet. because they have this public interest training. And they are aware of this principle of value creation from inputs to outcomes. And a lot of accountants are learning it on the ground and on the job, as it were. No accountant worth his or her salt today sits in a corner office and merely drafts an AFS according to IFRS standards for consideration by the audit committee. No, he looks at this whole value creation process. He's looking at what are the inputs into the company, how are the activities, are governance, risk, and compliance integrated, as are these functions integrated, are the operations integrated, and the product, how the company is making its money, what are the impacts on the three critical dimensions for sustainability and the long-term health of the company, and what are the outcomes, because the outcomes, if it was looked at that it's reducing the trust and confidence of the community in which you're operating, then obviously you've got to think again. So the accountant is, my experience being in the C-suites of many companies as an advisor, is the one person in the room that really understands this need to change the mindset of having been taught in silos, as I was, and many of you online were, and to start thinking on this integrated basis. Integrated thinking has stormed the world. That bastion has been stormed. The question of the connection between the financial and the so-called non-financial, there are many companies doing integrated reports around the world. But what the IFRS is trying to create now is, and I'll give you the exact words that are being discussed, is an overarching framework over the International Accounting Standards Board and the proposed International Sustainability Standards Board to connect those material matters to find, as I said, that which is having a significant impact on those three critical dimensions, and put it in clear, concise, and understandable language so that users can make a much more informed assessment about the long-term health of the company and its longevity, because that's very important for a pension fund. So, Patrick, I'm sure you'd like to add something to that.
Cool, thank you. Yeah, and maybe I'll focus on the first one. Does integrated thinking and reporting require some training or certification? Training is key. This is a different form, and many people have not understood this. And training is not just to the accountants, it's to all the people in the organization that are involved in the value creation. So as was alluded earlier, as the board of directors, the change in our thinking to incorporating three elements of sustainable development is a different mindset that many of us are still tagging along or trying to learn. The change of focusing, shifting from just shareholders to stakeholders is also a different dimension. The shift to only financials to the 6 capitals is also a different angle. And that means we need to empower ourselves on how to learn to think in an integrated way, to use the 6 capital to create that long-term value for the benefit of all our stakeholders, while we take into account the issue of the environment, society, and the economy. And we're seeing more courses starting to come on board on this topic. Hence the message I said earlier, as a council or as a committee or as an association, you need to influence both the Institute of Directors to include these programs, the accountancy bodies to include this in their qualification, and the tertiary institutions. In South Africa, University of Johannesburg has an integrated reporting course. I shared the one between the WITS, and Professor Marvin King has been heavily involved on it on Chief Value Officer. So this is coming on board, and I think you need to be thinking of the same in your respective country. On the question, is the role of the accountants to prepare? Is it the only role of the accountant? Yeah, Prof has answered very well. No, it's not just the accountants. It's all that needs to be involved in this value creation process. And most importantly for me is that there need to be changes on the systems and the processes to be capturing this information on the value creation, which means the integrated functions, the integrated departments, all all people within the organization are part and parcel of it. And Professor Marvin, I know one thing that you also shared with us a lot before is you seeing organization having created this role of the Chief Value Officer, Standard Bank in South Africa, and then there's a financial director reporting to that value creation officer, and a sustainability director focusing on these other elements on the environment and society. And I'm sure you're going to see increasingly such types of departments coming on board to say this is not just a reporting issue. Over.
Thank you very much, Patrick. This is a follow-up to your response. The question is, what are some of the ways that tertiary institutions can be brought on board for the purpose of training on good corporate governance?
Just to add again, this is the point on whoever becomes a champion, and I'm taking to use the example of Ghana Association of Integrated Thinking and the Reporting, and that also includes the corporate governance, how you start working closely with the business schools in the country and other tertiary institutions, so this can also be brought on board, is of critical importance. But besides talking of the tertiary institutions, if you think of South Africa, the Institute of Directors have also brought in professional courses, certified director and the chartered director. So those are the avenues as an Institute of Directors you can bring on board on how to train on the corporate governance. And Patrick Kabuya, CDSA, Chartered Director South Africa, helps me to market myself within the fraternity of South Africa, and that would be of benefit to anyone listening to us here. So I'm just adding not just a tertiary institution, but also through the Institute of Directors having these professional qualifications, which are recognized by your country qualification authority, is of key importance. Maybe Professor Marvin, can you have something else to add on?
Yes, I just want to add, Patrick, that Patrick is a director and I'm the patron of the Good Governance Academy. And my thinking in establishing that was to marry SDG 4, which is quality education, with SDG 17 collaboration. Now, through my travels around the world, I have got access to the great international bodies around the world. And what I've done is shared all these connections with the GGA. And we have 2 colloquia a year. The next is on the 18th of November, and I give an open invitation to everybody online to come. It's free of charge, it's no charge. And we have international speakers on these subjects. And one of the purposes of it is to educate the educators, to make sure that the educators are up to date as to what is happening around the world. Because when I, some years ago, looked at the figures in South Africa, just a part of our continent, there were 19,000 young South Africans who were getting MBAs, of which 93% were young Black South Africans. Now, that's our future. And postgraduate degrees, there were 9,000 odd postgraduates in masters or PhDs in MBAs. And there again, it was 95% were young Black South Africans. And that's again our future. Those are our future corporate leaders who need to come out as conscious corporate leaders. And if you look at the timeline of the SDGs 2030, my objective was to get the best of thought leadership at these colloquia to speak and to share it with these international connections around the world. So Patrick will confirm what I'm saying. We have the who's who of international bodies or members of the GGA support members. And we have their members who receive a summary, which is prepared by the chief executive, Carolyn, and myself, which goes to them and they send it to all their members. So the colloquium on the 18th of November, it looks at the moment that we will send that summary to about 5 million accountants, directors, lawyers in 131 countries around the world. And you will see there how you spread that knowledge. because it's a public good. That it's not something that's not intellectual property which you lock away in a corporate closet. These are things exactly, that quotation from Madiba, from Nelson Mandela, is exactly right. What you're doing, are you making a difference in the lives of others? And the GGA is certainly making a difference in the lives of many people. And so you educate the educators that they know how to teach these young people who are coming out, so that we will have in South Africa, certainly, but in other countries following the GGA, they will have young people coming out who are aware of this concept that the company is an incapacitated person, that they are the heart, mind, soul, and conscience of that company. And therefore they must act as conscious corporate leaders. And we've got that coterie now. We have this cohort that we will have these young people, Generation Z people, because we talk about diversity on boards and we talk about race and gender. But the critical thing in diversity is intergenerational diversity. We need millennials and Generation Z people. They think differently from me, and they think differently from Patrick, who's much younger than me, but even in his generation, they think differently. And when you discuss something with a Generation Z people, sometimes I find I get like a light bulb experience. And when the first thing they want to know is, how is it impacting on climate change? Climate change is critical to them, because if you think a young 20-year-old or 22-year-old today, his grandchildren in 50 years' time, what is our planet going to look like in 50 years' time if we don't get this thinking right? Well, it's going to be, I think, not a habitable planet. It's going to be problematic. So we have to get these things right. And our continent has the resources to do it, and we have the people, the young people, to do it. And that's why I am so keen in making sure they get the right education, and we get this coterie of young people coming out to lead these incapacitated companies on the African continent, and do it as conscious corporate leaders.
Thank you, Prof. I see a couple of hands up. I'll invite Mr. Zan to ask his question. Zan, you have the floor to ask your question. I also see a couple of hands, after which I'll give them the floor as well. So Zan, if you're there, please ask your question. So Zan is asking, is integrated thinking and reporting similar to the joined up planning that was advocated by people like Margaret Thatcher in New Public Management?
The answer is no, but Patrick, you can take it further.
Yeah, true. Yeah, so I've tried, but when I always figure out about the integrated thinking, it's a whole value chain of the organization, from the point where the board of directors, in terms of helping to define the purpose of the organizations and the value that will drive that purpose, the business model of the organization that will include the 6 elements of the 6 capitals into that organization to create that value, and then the operations within the organization and the reporting dynamics. So this is not just about the planning, but it's a whole chain, the value, the business creation process, from, I once again call it, from the input, the business activities that you end up with, the output and the outcome of the organization, taking into account the 6 capitals. So this, in a nutshell, maybe saying no and trying to explain this far much better by taking into account that business model of an organization, from input activities to output, and then the outcome of the organization. And the intention of those outcomes is either mainly to increase the values of the 6 capitals that we spoke about, or try to ameliorate them so that the impact is not that material.
Thank you very, very much. So I have a couple of hands up. I'll give the floor to Dick Godwin to ask his question. Dick.
Good afternoon, senior colleagues. Please, I want to ask Mr. Kabuya and Prof Marvin, that do they recommend integrated reporting to be incorporated into the Public Financial Management Act or regulation for the public sector COVID entities? And then you also recommend it for the Companies Act or Code as part of the requirement for the directors, the annual reports for the directors. Thank you.
Sure, I'll answer that question. I am not a great believer in legislation because then you get a mindless approach to things. The Public Finance Management Act has failed dismally in South Africa. You all know that our state-owned enterprises in South Africa are, I'm going to put it euphemistically, are struggling to survive, never mind to thrive. They're struggling to survive. And they are subject to the Public Finance Management Act. That Management Act has been operative since about 1997. And it's been breached many, many times. And there hasn't been one prosecution to date. The first prosecution was to Mr. Greasy, who was gave evidence at the Zondo Commission about Bosasa, a company that was allegedly bribing government officials to get government contracts in billions of rands. And he was charged on the Public Finance Management Act, the first person, and he wasn't a public servant. The Public Finance Management Act is slipping into disrepute. They took language like chief executive, turned it into accounting officer. I think the concepts of integrated thinking and integrated reporting need soft regulation. Now, what do I mean by that? I mean exactly what has happened in South Africa, that the Johannesburg Stock Exchange has it as a listing requirement that you do an integrated report, which drives you to think on an integrated basis. So once listed companies are doing it, they start looking at their supply chain code of conduct. And they are now asking questions of their supply chain. How are you making your money? How are you conducting your business? Because those companies listed on the Johannesburg Stock Exchange have learned that if it becomes public knowledge that one of their suppliers is using child labor, for example, that the next day on the stock exchange they could lose 40% of their market cap. So legislation is not the answer. What the answer is what is happening is that in the capital markets of the world, when a company issues, let's say, a bond with a coupon for bidding in the capital markets of the world, the great asset owners like the Norwegian Oil Fund, the great asset managers like BlackRock, do not only do a financial due diligence, they're now doing an ESG due diligence. And in that, one of their questions is, have you got a supply chain code of conduct? Have you been monitoring it? What's happening in your supply chain? Now, why do they ask that question? Because they're going to take their beneficiaries' money and invest in this financial instrument issued by this company. And if it's disclosed that in their supply chain they have child labor, that company's market cap is going to reduce, and the value of their financial instrument that they've invested beneficiaries' money in is going to reduce in value. So market forces are starting to drive the question of the ESG factors as a critical factor in value creation. So a long answer to your question, but legislation is not the answer.
Yeah, thank you, Prof. Prof, somebody is appreciating your position on the legislation. Somebody is commenting that it's obvious corporate boards have the responsibility to ensure integrated thinking and reporting, but can we push it a little further so it becomes a mandatory requirement for listed companies on the continent? And this is a question from Dr. Frank Watten.
The answer to that is yes, because I think stock exchanges across the continent can actually look at the question of making it a listing requirement that they actually evidence, the companies that are listed, evidence that the board, the collective mind of the board, is making business judgment calls on a basis that the collective mind is unified, it's not fragmented. They're all thinking of the same purpose. They are all thinking of critical key performance indicators and key risk indicators. And when they're making that business judgment call, they're aware of the 3 criteria of the business judgment rule. They've got no financial interest in the matter. Objectively speaking, they have all the facts available to them to make that decision. And it appears to be a rational business decision at that time in those circumstances in the best interest of the company. So note that the criterion, one of the criteria is rational business decision at that time in those circumstances, not the correct one. I talk to you covered in corporate scars because I've been party to wrong business judgment calls. And the law recognizes this through the business judgment rule. And because the law recognizes that a person of integrity and skill and becomes a non-executive director, puts his personal reputation and his estate on the line. And it would be inequitable for a company, even though it turns out to be a harmful business judgment call 4 years later, to sue that director for damages, provided he's fulfilled those 3 criteria of no financial interest, objectively had all the facts to enable him to be informed to make that decision, and it appears to have been a rational business decision at that time in those circumstances, not the correct business decision. So stock exchanges can play a role in getting boards to start really thinking on an integrated basis, and then do this. I'm going to use new language that I think is going to develop into 2022, this overarching framework over the financial reporting standards and the sustainability reporting standard.
Yeah, thank you, Prof.
Hello, President.
Yes.
Yes, please. Sorry, I couldn't unmute earlier. Thanks, Prof. and Patrick, for the insightful presentation. I would want to find out, has there been any argument or debate against integrated reporting and thinking? That is what my question is. Thank you.
The answer is the only argument is the format. There's absolutely common cause between the task teams working now in this ESG space to develop the ISSB under the IFRS. I'm using all these acronyms. One thing is common cause, that the material financial and the material non-financial matters have to be connected. You can't just leave them sitting on their own. They have to be connected. And I call it integrated. So they might change the name to connected. I don't know what is going to happen. I'm not the IFRS, and I'm not the IOSCA, and I'm not the SEC. These are all, in these great international bodies, are playing a role in this. But one thing they've realized is that we have to change, the boards of companies around the world, have to change their mindset from driving profit at any cost to thinking that the company operates in this triple context of the economy, society, and the environment. And if there's an adverse impact on the environment, what, Mr. Chief Executive, to you and your colleagues, give me 5 reasons how you're going to eradicate or ameliorate these negative impacts in the year ahead. And you have variable remuneration so that you have the budgeting to increase the bottom line by 7% EBITDA. If you pass that, you get 1/3 of your package. The next thing, these were the adverse impacts on the environment, how we made our money last year. Give me 5 or 6 ways how you're going to try and eradicate or ameliorate that. If you achieve that, you get another 1/3 of your package. These were the negative impacts on society. How are you going to eradicate or ameliorate this? And these were the positive impacts on the environment. How are you going to enhance those? So you have this incentivization covered by these three critical pillars. And if at the end the person earns 9 million rand, 3 million rand for each pillar, it's much more palatable to the general public out there and to stakeholders that they've been incentivized and they've actually improved the way the company is impacting on the environment, which improves the quality of lives of all the citizens. Let's assume the companies in Ghana, much more than USAID. Because USAID, as you know, will end up in the hands of a politician. It might slip through his or her fingers. And it's for the X purpose, it gets used for the Y purpose. But if every company in Ghana today practiced this integrated thinking and did an integrated report or overarching framework to connect the financial and the so-called non-financial, and actually made sure that it was adding value to society, Ghanaians would be much better off than they are today. So, and that's where we have to go to try and make sure that our planet is a habitable one for those who come after us.
Yeah, thank you, Prof. There is one from Celine now. She appreciates your presentation. She says it's brilliant speaker so far. Thank you. Prof King, do you have any lessons to share about the COVID pandemic and how it has affected the role of boards, if at all it has? Madam Selena, could you speak to your issues, please?
Hello, thank you very much for the opportunity. Great speakers, thank you so much. I had a question with regard to the impact, if any, that the COVID pandemic has had on the effectiveness of boards. That was my first question. And then my second question was with regard to the tone at the top and how we can really see that being implemented. I'm based in Zambia. Thank you.
All right, I'll try and answer that, and Patrick, you can add to it. First of all, I want to go back to the question of building a business model and making sure you get buy-in from the top to the bottom. Because when you do get that buy-in, you get pride in the company and everybody feels they're making a contribution. And one of the consequences is that you have less corruption as well, because morale in the company is high. So when you have a business model where you get buy-in from the top to the bottom, my experience is you achieve extraordinary things. And but if you don't get that buy-in, you won't even achieve ordinary things, and it's problematic. The tone at the top is changing because even great headhunters like Heidrick and Struggles are today advertising for chief value officers. So the concept is now caught on globally. And there's a realization that the whoever is in charge of this value creation process, I'm going to say it's the accountant as an example, he or she is looking, as Patrick has said, from inputs to outcomes. It's this whole value creation process. And they have to change their mindset to think like that rather than just thinking of increasing the economic success of the company, but being subsidized by society and the environment. Because what is happening, Celine, is that you actually subsidizing that bottom line profit if it's not, haven't taken account of how it's impacting adversely on the environment and society, because that's causing your quality of life to be diminished. So Patrick, I don't know if you want to add to that.
I just add on the one on the COVID-19 impact. There have been plenty, but for today just add three things. One, I guess by thinking about the COVID-19, we've seen many companies digressing and starting to focus on the social element. So the issue of the purpose, why do we exist and what value are you bringing to the society, has become more enlightened, and it's a point that boards of directors today are questioning themselves regularly. Is our purpose the right one, or do we need to change it? I think the second, and I say there are many, is the issue of things like the succession planning within the board or the senior management level. If a person is sick today in the board or the chair is not available, how do we deal with continuing running of the board affairs or the senior management if one of them falls sick? How does that work? So that element on the succession planning and covering for someone else has also become a very important dimension all through. And the third is how the board operates during this period using the digital technologies. It's obviously a good advantage, and I think you're asking how effective this is going to be. So you're seeing more boards moving into hybrid, some virtual or others being in a meeting. If there's full lockdown, you all have to go into virtual. And here I think I would suggest that the Institute of Directors of Ghana and the institute represented here to start preparing type of a document or a guide that can start empowering your members on how do you host a hybrid meeting in terms of the agendas, in terms of the chair running the meeting. So those three aspects just wanted to bring on board. And then just to add to the message, how do you change the tone at the top? Yes, the Prof has said a number of things, but for me, I also think we need to strategically start thinking of how are we appointing our board members. So is it me just calling a buddy Celine that you become my board members? This issue of opening up, the president talked about SIGA saying we are advertised for the positions, interview and bring those people who are brilliant. This important thing. Ensuring secondly is we do a good orientation and training for our board members. There are many boards don't do orientation and don't conduct trainings for their members. I sit in some boards where we have to sign in a CPD form at the end of every year on the trainings that you've attended. The role of the chair is critical, how you appoint the chair and ensure there is balance. For those people who come to the board meeting, they're not prepared, they're opening the pack when you're in the board meeting, the chair needs to take control of that and start changing those dynamics and the attitudes in the board, and that needs to change. And the final one is also the board evaluations. These need to be taken seriously. Annual evaluation, maybe self, and at certain every second, if you think of King 4, every second year, bring in an external person to do the evaluation of the board, and the board needs to act on whatever comes out of that report, and most importantly, disclose through their integrated report on how they're addressing, how they have conducted the evaluation and how they're addressing it. So this issue of board appointment, orientation, evaluation is of critical importance. And President, before I go, I saw a question about what's the skill mix in the board, because it links to this. Again, King 4 has a very good guidance that we need to have board members with appropriate knowledge, skills, and the experience having the board, so that they bring that diversity of mindset. And of importance here, I always encourage is that the board needs to be conducting a skills evaluation at least once a year to see what skills do we need, do we have them, and what gaps are currently existing. And in that, doing that skills map, think of the new developments happening around you. Climate change is important. ESG that you're talking about is important. Sustainability integrated reporting. Do we have those skills? And how do we include them in our matrix? Then, when you are nominating or selecting new board members, you bring those skills. So that becomes a criteria for the appointment of board members. And this means then board members needs to have a term. So you rotate them, bring new, fresh ideas and blood within the board of directors. And that is critical as part of your succession planning. I stop there, and thanks.
Thank you very much. So in addition to all of this, is about our commitment as leaders at the top, so we must be committed to the doing. Sometimes we talk and talk and talk, but with very little at the doing front. And if we're talking about mindset change, for me, one of the critical things to implement this change at the top is about a culture of doing. That is the way we can get results if we have to succeed. As for the talking, I believe Africa has a lot of it. What we need, in my view, is develop a culture of doing, implementation. And that must be a call moving forward. I will give the floor to Nalek Handa.
Thank you so much. And thank you very much for quite an insightful presentation. My name is Nailoke Manda from Namibia. I would like to gauge Prof. King's opinion on the following, on a certain quote or on a certain remark made by Prof. Crowson in 2008. in reference to mining, and I quote as follows. The remark said, mining is first and foremost an economic activity. As in any other economic sector, mining companies are in business to earn profits, and that is their basic justification and objective. In recent years, it has become fashionable to talk of a triple bottom line, meaning that companies have to meet social and environmental objectives as well as financial ones. There can only be one bottom line, which is profitability, and to pretend otherwise is essentially self-deluding, unquote. In reference to the ongoing discussions of ESG due diligences and integrated reporting, what are your thoughts on that statement, on that very defining remark, Prof. King? Thank you.
Well, the person who made that statement is obviously a student of the late Professor Friedman, because that's what Friedman said. And his thesis was carried out, and the consequence was we had a century, 20th century, of unsustainable development, much to the prejudice of you, Naloki, and much to the prejudice of your fellow citizens in Namibia. So the mining companies around the world have realized that they are extracting, they're in the extractive industry, and the extractive industry can be destructive to the environment. And the question of the rehabilitation of land after they've mined has become a critical issue. And some countries have criminal sanctions against directors personally if land is not rehabilitated after mining. So if I were a director of a mining company in Namibia, I certainly would not talk about I must meet objectives of society and the environment, but I would look at the business model of how we are extracting that mineral. Are we doing it on a basis that we don't care about the impact on the environment? We don't care of the adverse impact on society. We don't care about health and safety regulations in the mine. Well, if you're adopting business like that, then I'm afraid you're not going to be sustained. You're not going to, especially in the era of social media, your business is going to die, and you will cause much harm to your fellow citizens. So I also take the oil industry. Most pension funds today have, for example, Shell or BP, one of the great oil companies, as equity in their pension fund. So if Shell had to switch off their oil rigs tonight, there would be a big hole in your pension fund, and including the dividends that flow out of Shell, which are good, and they're very important for income into your pension fund. So the oil companies, so the purpose of Shell today is to become an energy provider in a sustainable manner, and they're working towards it. They're working towards replacing the fossil fuels they're digging out of the ground with renewables. But it has to be transitioned because society and the economy is so interlocked with mining and with the oil companies that you cannot just stop mining today. If you stop mining in Namibia, the economy would go bankrupt. Your pension fund would probably go bankrupt. So you've got to transition these things. And the people who are at the top, the directors of that mining, have to develop a business model where they take account of the extraction, what impact it's having on society and the environment, and then work with management as to how they can eradicate or ameliorate those negative impacts, because they owe it to society, and they are the conscience of the company. And the company doesn't cause that harm. They, the directors, do it. So I don't agree with his statement. In fact, I disagree with it entirely. And he's absolutely wrong. And it's to the prejudice of every Namibian citizen, that statement.
Thank you very much, Prof. Now, Engineer Duncan's question. Professor King, how can disclosures about corporate environmental and social impact be made a key agenda at AGMs and quarterly media updates? What happens in the AGMs are entirely about accounts and focus on endless growth. That is what excites the media for headlines. Can the narrative change in order to enhance integrated reporting?
For board meetings, now, before you get to your AGM, there are agenda items which I suggest you should have on your agenda, which I'm prepared to wager that the majority of companies in your country do not have this on your agenda. First of all, stakeholder relationships. You should be informed at each board meeting what is the relationship between the company and its stakeholder groupings pertinent to the business of the company, such as your employees. What is the relationship with your employees? What is the relationship with your major service provider? These are dynamic issues. They don't static from board meeting to board meeting, they change. Some big companies with lots of employees and some operating in different jurisdictions, company which I chaired, I appointed and started a corporate stakeholder relationship officer. And her job, it was she who was appointed, and she was part of the job description, have you been the chief executive of the company? So a senior appointment to talk to stakeholders, to learn and understand their needs, interests, expectations, and concerns arising out of the pandemic. And at every board meeting have a written report on stakeholder relationships. So the board is more informed in looking at management's proposals on strategy and not blindsided as to what the dynamic is of stakeholder relationships. So an agenda item, stakeholder relationships. Next agenda item, inputs to outcomes, should be discussed at every board meeting. The outcomes that are happening, are they affecting the characteristics of our company? Are the external stakeholders seeing our company differently? So that should be discussed. The risks and opportunities on our business of climate change should be an agenda item. The risks and opportunities of cyber security, absolutely critical, because IT governance and cyber security and climate change are the two major risks to business in the future. And then the final agenda item is supply chain. You've got to know what's happening in your supply chain, because if there's a breach of human rights conventions in your supply chain, it will impact adversely on your reputation, your company, and on the value of your company. So that these things are discussed at board meetings. And when you come to your AGM, what is happening today, the shareholder activist has been replaced by the civil society activist. The shareholder activists used to ask questions about remuneration. That was the main question they asked. How much money is the chief executive earning? That was their concern, because the more money the management earned, the less cash there was to pay dividends. So they actually had a conflict. But today, civil society arrives. WWF arrives, having bought one or two shares. They arrive at an AGM and they ask a question through you, Chair, that the chief executive sitting here, can you please explain to me in detail, how did the company make its $100 million this year before tax? How did it do it? These were the impacts on the environment. How are they going to try and eradicate or ameliorate those impacts? These are questions that are now being asked at AGMs, because there's this whole change in attitude. And the pandemic, don't let a crisis like this get lost. It's galvanized the executives in this, what I call alphabet soup of framework providers and standard setters in the ESG space to actually start collaborating. In March 2019, I said publicly that it's a social outrage that these executives were running these standard setters and framework providers as if they were competitors, when they should be collaborating on these public interest issues for the public good of all the people in the world. And the pandemic, these executives saw how scientists collaborated and developed a vaccine in 9 months instead of 9 years. And it galvanized these executives into issuing the white paper of the Group of Five to collaborate. It galvanized the World Economic Forum to issue metrics to try and get harmonization. It galvanized the International Financial Reporting Standards to say we're expanding to sustainability. It's galvanized to create an international sustainability standards board. So absolutely, AGMs have become important, but the questions that are being asked have changed. And the directors will already have reported differently. And the shareholders and the others attending the meeting will be more informed because of the quality of the reports, which is the lifeblood of accountability. So Patrick, I don't know if you want to add to that.
You've done very well, and I just also want to mention in South Africa, we've seen increasingly in the AGM the agenda of climate change. So they're including a resolution. There's an organization, as said, civil society organization, raising the question, we want to understand your climate change adaptation and mitigation procedures. So just share, and it's becoming very common in most of the boards, which obviously means that we need to empower more the members of the public so they become enlightened and start asking these questions. But I can see that the change is happening, and with the ESG, that is even going to increasingly become more important in the future.
Thank you very much. I think we are almost at the end of the session. Prof, let me ask my question before I give my closing remarks. Prof, this is a direct question to you. South Africa is known to be one of the best countries, one of the countries that promotes the culture of good corporate governance. What is the secret?
Well, I don't want to blow my trumpet, but I think the King Committee has had a huge influence in South Africa. And if you look at the private sector companies, and I had this discussion with one of our ministers a couple of months ago, virtually, started saying to me, well, the King report, but there's still corruption in the private sector, because when you've got a corruptor, you must have a corruptee, and vice versa. I said, that's correct, but let's have a look. Let's take the 350 odd companies listed on the Johannesburg Stock Exchange. Let's take them as apples. Now, put the rotten apples in a basket and name them. Name these apples. He was able to name 6 apples. 6 apples. I said, now let's take the 700 odd state-owned enterprises in South Africa. Now, not put bad apples, put good apples in a basket. Put good apples in a basket. And, well, he couldn't put one apple in a basket. And the state-owned enterprises have to follow the legislation of the Public Finance Management Act, which is so detailed that executives in great state-owned enterprises such as Transnet have told me they're spending 60% of their time on conformance, on ticking boxes mindlessly, because they've got a sanction of 5 years imprisonment hanging over their head. Instead of focusing on performance, they're focusing on conformance. The King report says these are the outcomes which you should try and achieve in the way you act, the way you conduct business, the business judgment calls you're making. If you can achieve these outcomes, and when you're making a business judgment call, ask yourself the question, what impact is it having on these 4 outcomes? And if it's an adverse income, then think again before you make that business judgment call. So the King Committee has driven this change in mindset of companies, certainly listed on the Johannesburg Stock Exchange, and they themselves are putting pressure on people in their supply chains. So the thinking, the mindset change in South Africa has happened. And South Africa is seen, it's not me, PwC did a survey, is seen as being the country with the best integrated reports in the world. And the next country was the Netherlands, and so on and so forth. So I think the King reports have had a huge influence on what has happened in South Africa. And I think this, and it's fascinating that this approach of mindful outcomes-based governance is now starting to take hold all over the world, because there's an appreciation that before it was adding no value. But here you've got a governance format which can actually add value into your business judgment calls.
Yeah, thank you very much, Prof. We've run out of time, but let me give 1 minute to my Vice President, Dr. Mike Juru, to make, any submission if you have any. You have just about 1 minute to do that, so I can give my closing remarks. Dr. Mike Juru, you have the floor. Distinguished ladies and gentlemen, our guest speakers, Professor Mervyn and Patrick, I want to say a very, very good thanks to you for that insightful presentation. You have educated us very well. And as leaders on the continent, we have taken note of critical issues. Prof has taken us through memory lane from the 19th century to the 21st century. Prof has succeeded in defining, what integrated reporting and thinking is. And I know that it encourages the publication of a report that explains how an organization creates value over the short, medium, and long term. This type of reporting seeks to communicate exactly how an organization's strategy, governance, performance, and prospects in the context of its external factors can lead to value creation over time. It also pushes for the consideration of sustainability risk so as to have companies adopt more sustainable practices, which leads to the benefit to all stakeholders. Integrated reporting is now regarded as the future of corporate disclosures. I know that this is a global development now. There has been continued adaptation of IR integrated reporting across the world after the framework was introduced by the International Integrated Council in 2013. It is important to note that all of these will lead to better decision-making, corporate transparency, more responsible and sustainability considerations, and increased interest in organizations by all stakeholders, and better external relations. I also know that corporate reporting is the lifeblood of accountability. And so governance must be an outcome-based, and this looks at value creation in a sustainable manner, effective controls, trust and confidence and legitimacy, and ethical and effective culture. Our African continent recognizes that we have a continent full of resources, but we need to change our mind to be able to plug into the opportunities that we have. And the way to do it is about not working in silos, embracing on the new paradigm of integrated thinking and reporting, that in the boardroom, our critical agenda must reflect stakeholder relationship, inputs and outputs, risk and opportunities on climate and security, and supply chain. Now, living here, should we become hearers only? No, we should become doers. So we must go back to our various countries and institutions to propagate this news of ensuring that if we do this effectively, if we consider the environment, society, and the economy in the way we model our business, our economies will be transformed. And organizations are encouraged to form institution associations to promote the promotion of integrated thinking and reporting culture. On this note, I want to thank all of you for coming. And let me hint that we will have our next engagement towards the end of October, and we're going to have an engagement between academia and industry. Most of the things that we do in industry are left sometimes unattended to. At the end of the month, as part of the Chairs Forum, we will be looking at bringing industry and academia together. So look out for the invitation. And so with the fallout from all of these 3 knowledge sharing sessions we have had so far, we'll be issuing out a communique to inform a well-managed implementation of the fallouts. On this note, I wish you all a good week, and we thank you for your participation. And Prof, once again, on behalf of the ACGN Chairs Forum and all stakeholders as far as corporate governance is concerned, we want to thank you for making time, and we look forward to a sustained relationship as usual. We wish you thank you. And on this note, I bring the meeting to a close. I wish you well, and have a good evening. Thank you.
Thank you very much. Thank you.
Thank you, and Kwaheri.